Investors are disappointed at the poor market performance this year, on top of the tepid performance last year. India is hugely underperforming other markets. The relevant questions are: what are the reasons for this underperformance? Which are the segments performing well? What should be the investment strategy? Welcome to Geojit Spotlight. First, let us look at the degree of India's underperformance. The underperformance is huge. Here is the data. I'm giving you year till date returns, YTD returns. MSCI World Index up by 5.83%. MSCI Emerging Market Index up 14.61%. US S&P 500 up 6.98%. Brazil's Bovespa 14.17% up. Now the star performers: South Korea Kospi up an incredible 71.46%. Taiwan's TAIEX up 41%. And India's Nifty down -7%. Huge underperformance. Of course, there are worst underperformers like Russia, which is down 41%. And if you look at the best performers like South Korea and Taiwan, in South Korea, two stocks, Samsung and SK Hynix, are driving the rally. And in Taiwan, just one stock, TSMC, is driving the rally. So this bull market in these two countries have concentration risk. Now it is very clear from the data that market performance this year has been dominated by the AI trade, artificial intelligence trade, a trend which is a continuation of last year's trend. So the reasons for the underperformance of India are clear. Foreign portfolio investors are selling big time in markets like India and moving the money to markets like mainly South Korea and Taiwan, and also markets like US and Japan. Earnings growth and expectations of earnings growth are driving the market. This year's earnings growth in South Korea is expected to be around 100%, something unprecedented and very unusual. But the fact is that companies like Samsung and SK Hynix are reporting incredible profit growth. This is a continuation of last year's excellent profit growth. And these companies have huge order book which they can execute over the coming next 18 months or so. So the resilience is likely to continue. Let me come to my second point. Even though India is underperforming at the index level, the underperformance is mainly concentrated in the two large segments: private sector banking majors and IT stocks. IT's underperformance is due to the expected negative fallout from the AI shock. So there is no buying in the segment and there is selling. Private sector banking is performing poorly despite the good results and in spite of the decent credit growth. This is because this segment is the largest component of FPIs holdings and there is huge liquidity and it is easy to sell. FPIs are selling the segment to move money to better performing markets, as explained earlier. The third point that I would like to share is that there are segments across market caps, large, mid and small, which are doing well. For instance, automobiles, pharmaceuticals, capital market segments, and to an extent, digital companies and defense companies too are doing well across market caps. Even large caps are doing well. There is great resilience in these stocks. So the broader market, the mid and small caps, are outperforming despite the high valuations. The reason is that the FPI exposure in these segments is limited. In fact, they are buyers in this segment, since a correction is not expected. So, in brief, if you are a value investor who sees value in large caps, remain invested in large caps which have decent growth prospects also. You can even accumulate stocks in these segments. But if you are a growth investor, ride the momentum in the broader market. If you are a value investor, you will have to wait for some time to get good returns. In the growth segment, there can be a correction when the value stocks start showing results. Best wishes.